Hello everyone and welcome back to the channel, and I hope you guys are doing great. So in my today's video, I'm going to talk to you about a company called as AXISCADES Technologies Limited. We're going to go through their recent year-end result. We'll go through the important strong points from the con call summary, which is very important because their Q4 revenue target was not met and the whole year target was also not met. So we'll understand why does it happen and what the company is doing for the future growth. And before we get into that, right, I'll just tell you in brief what does the company does, right? So the company actually earlier had this engineering services business, which was not that margin lucrative, and then later they got into into aero defense. Aerospace, defense, and ESI side of the engineering business. ESI is nothing but electronics, semiconductors, and artificial intelligence. So these that what they have entered, right? And now what the company is planning, right? They have realized that this is the segment that they want to be in it, and they are planning to divest from their old legacy business, which is engineering services business. So that's what you need to understand it. So let's go through their number. So if you look at their YOY revenue, right, increased for Q4 26, it increased only by around 2% to 273 crores, and PAT was down by almost 98% to 0.42 crores. And if you look for the whole year revenue, it grew only by around 12.5% to 1,159 crores, and PAT was up by was was did not grow at all. It stood last year it was 75. This year it was around only around 72. So we'll get into this information with the with the management project why they had a problem. So what they said, right? So there was a revenue of 142 crores, which was supposed they were supposed to realize it in in Q4 of FY26, which did not come. So they what when they gave the reason, they have split it into three categories because they are part of three different projects. So first is the 45 crore revenue. So this was related to the defense manufacturing program. This got delayed because due to the supply chain issue. And then the another one was 84 crore strategic electronics program. Over here, the issue, what actually happened because of the war issues which were going on, right? So the hardware, so the supply who supplies these hardware related to this, electronics program, right? They diverted their production to war related programs. So they deprioritize what Axis Kids wanted. And that's why the over here there was a delay, and the last was around 12.6 crore, which was from around aerospace and different contract, which also got deferred. So this comes up to around 142 crores. But the one what the management tried to convince and tell that the revenue is not lost, it's just deferred. So instead of earning this in FY26, it will be earned in FY27. So they were very clear about it, and they said you should not worry that anything is wrong with the business. And if you look at the segment-wise revenue breakup, right, I'm going to take only the business which they're going to keep it because they, as I told you earlier, right, they are divesting and selling their legacy business. So from the aerospace, they the overall revenue was around 388 crores. Defense was around 379 crores, and ESI, which is electronics, semiconductor, and artificial intelligence, was around 137 crores. So that came up to around 75 to 78% of the revenue from the 1,159 crores. Going forward, that would change because they are completely divesting off from the legacy business. So let's see what are they trying to do, right? So as I told you about the divestment, right? So they are restructuring their whole business. So they have already got into an agreement with a company called Akkodis, and where they are selling their legacy business for around 30.63 million US dollars. And this will happen in the first half of FY27. And what they will do, right, the money which they will get from this whole divestment, right, they are going to invest in the segments which they currently have, right? So they do not have to take any loans or raise any dilute any equity. So that is the first thing. And if you look at the in terms of the expansion, right? So they're doing a huge expansion because so if you look at their total capex plan, right? So they have a total capex plan of around 2,100 or 2,250 crores. And what they're trying to say, right? They're going to fund this completely through the restructuring phases. The first phase, which I told you about, selling the legacy business for around 30.83, we have to see where the other money comes from. And they have divided where they're going to put it. So they have this DAC, which is Devanahalli Capex, which is coming up where the majority of the Capex is going around 1,200 crore. Then they have this missile Atmanirbhar complex, which where the capex is around 300 crores. Then they have a DAL complex, which the 120 crores would be invested. Out of that, 100 crores is already invested, and the remaining 600 crores, right? They will use it for acquisitions. So they are very clear about this, right? So they want to grow organically, but at the same time, they want to do acquisitions which will help propel their growth. And if you look at their expansion, right? So this Devanahalli, the DAC, which is Devanahalli complex, and the MAC, which is the Missile Atmanirbhar complex in Hyderabad. They said that it will be operational will be operational over the period of whole of FY 27, and they're saying that this is not just alone. After this, once this is done and up and running, there will be expansion further to that also. And if you look from the acquisition perspective in FY26, they have already acquired a company in aerospace manufacturing, and which will help them, engage in high value activities and from the Q3 of FY27. So this acquisition which they have done in FY26 still not contributing to the revenue. It will only contribute from the Q3 of FY27. And as I said, right, they have kept a capex of around 600 crore just for acquisition. So they have another four companies in line, but they have not disclosed the divisions. And plus they have not disclosed the name of those companies. And the other thing what they have established recently is, right, they are established a space division. What so over here, what they're planning to do, right, they're planning to manufacture space bus, space payloads, and then there is something called a synthetic aperture radar. This is what they're trying to develop, and this is going to happen in their Devanahalli complex only, and they're building infrastructure related to that. And over here, what they're trying to do, because they do not have the complete expertise on this, they're looking for partnerships for manufacturing. So they have just established the division. They know what they want to do, and they're looking for partners so that they can start manufacturing, these products under the space division. And if you look in terms of the guidance, what they have given, right? So they said that they are going to grow by 52% in the retail business, and the revenue could be around 1,377 crores. So over here, the management is also very clear. When they're giving the revenue guidance, they're giving the revenue guidance on the 938 crores, which has come from the aerospace, defense, and the ESI segment. So they're completely excluding the legacy business because they have already they're selling it off, and it will stop contributing to the overall revenue from the coming year. So that will be a growth of almost 52 percent, and they have also divided how the revenues will come. So there are almost 927 crores are orders are already under execution. 285 crores will come from design win, and 165 crore will come from the acquisitions that they have currently done. And what the management is saying that the EBITDA that they are targeting over the long term, right, is between around 25 to 20%. So these are what are their plans, right? And one of the other important thing when I was researching and reading about this company, so they have this PAR 930 target where they are targeting to grow their revenue from the current, if I take it, the 900 crores which they have in their retained business to 9,000 crores by 2030, which is, if you actually look, it's quite humongous task. So obviously, the people on the call, so they had a question. They're like, "How are you going to do that?" Right? So what they said, and I think it genuinely makes sense, right? They said they earlier they were only into designing of these engineering things. Right now, what they are as they are moving from designing to manufacturing, it makes a huge difference. So, for example, in designing, if it is only 3% of the revenue, the remaining 97 comes from the manufacturing. So they are saying that because they are moving from designing to manufacturing, the revenue can automatically increase by almost 10 to 20x. Obviously, we have to now wait and see because they're going to start their aerospace manufacturing. Then they're looking for partnerships in the space division manufacturing, and obviously the other division which is already there for in aerospace and defense. It is growing by setting up of the new facilities in Devanahalli and in Hyderabad. So if I look at this company, right, even so they have a good plan. And the other good thing what they're doing is, right, they are very clear in what they want to do. So they once they got into this aerospace defense and ASI and the space division, they realized that they don't want to be in the legacy business, which is margin dilutive overall, and takes that drags the whole margin down. So they are divesting from it and completely concentrating. So their vision is very clear what they want to do. But on the other thing is like 4 years is a long time, and achieving 9,000 looks challenging, but definitely not impossible, right? Because the reason that they gave is also makes sense. So let's see how well they do. And another important thing, right? Because currently the legacy business, which has less margin overall, dilutes the margin. Going forward, when when that legacy business goes, it will help them improve their overall margin also. And if we look from the current perspective of the P or the valuation, it looks quite expensive because I think it has already touched. Let me just check. It has already touched a P of close to 105. But if I take from the revenue perspective, what they are targeting, like you know if I take the word of the management, which is 9,000 crores, and if I take, let's say, they even do PAT of around close to 10%, which will be 900 crores. The P, the forward P by 2030 comes only to 10. But obviously, that is the future estimate. How it will go, no. But if they are able to achieve the target, then even though at this point of time the stock doesn't look expensive, but obviously I would suggest you guys please do your own analysis before taking any decision. This is my analysis and what I understand. If I was investing that from a future looking perspective, and if the company is able to achieve that, the company still is not that expensive, because we need to remember, right, what happens in the future importance more to what has happened in the past in the stock market, right? So that one thing we need to be clear of. Otherwise, I think it looks all good for the company. They are divesting, they are investing in their growth, and they're moving from designing to manufacturing, which they believe that increase their revenue by 10 to 20x. All we have to do is keep following them and keep a track of this business. And if you guys like this analysis, please do hit like and subscribe to my channel. Thank you and God bless you.